Good morning, candidates. This will be useful for commerce graduates or MBA finance graduates or for chartered accountants going for interview. These terms. So capital funds, equity contribution of owners. The basic approach of capital adequacy framework is that a bank should have sufficient capital to provide a stable resource to absorb any losses arising from the risk in its business. Capital is divided into different tiers according to the characteristics or qualities of each qualifying instrument. Revaluation reserves are a part of tier 2 capital. These reserves arise from revaluation assets that are undervalued on the bank's books, typically bank premises and marketable securities. The extent to which the revaluation reserves can be relied upon as a cushion for unexpected losses depends mainly upon the level of certainty that can be placed on estimates on the market values of the relevant assets and the subsequent deterioration in values under difficult market conditions. Leverage, ratio of assets to capital. Capital reserves, that portion of company's profits not paid out as dividends to shareholders. They are also known as undistributable reserves and are plowed back into the business. Then Basel Committee on Banking Supervision. The Basel Committee is a committee of bank supervisors consisting of members from each of the G10 countries. The committee is a forum for discussion on the handling of specific supervisory problems. Risk-weighted assets. The notional amount of the asset is multiplied by the risk weight assigned to the asset to arrive at the risk-weighted asset number. Risk weight for different assets vary. Example, 0% on government-rated security, 20% on AAA-rated foreign bank. Non-performing assets, an asset including a leased asset, becomes non-performing when it ceases to generate income for the bank. Total income, sum of interest, discount earned, commission, exchange, brokerage, and other operating income. Net operating profit before provision minus provision for loan losses, depreciation in investments, write-off and other provisions. Average yield, interest spent on deposits and borrowings, but divided by average interest bearing liabilities into 100. Interest paid on borrowings divided by average interest bearing liabilities. That is the extent of liabilities into 100. Return on asset after tax. Return on asset is a profitability ratio which indicates the net profit generated on total assets. It is computed by dividing net income by average total assets. Formula, profit after tax divided by average total assets into 100. Net interest income. The net interest income is the difference between interest income and the interest expenses. CASA deposit, deposit in bank and current and savings account. Liquid assets consists of cash balances with RBI, balances in current account with banks, money at call and short notice, interbank placements due within 30 days, and securities held for trading and available for sale categories, excluding securities that do not have ready market. Venture capital fund, a fund set up for the purpose of investing in startup businesses that is perceived to have excellent growth prospects but does not have access to capital markets. Held till maturity, securities acquired by banks with the intention to hold them up to maturity. Yield to maturity, is the yield promised on the bond holder on the assumption that the bond will be held to maturity and coupon payments will be reinvested at the YTM, that is yield to maturity. It is a measure on the return of the bond. CRR, cash reserve ratio, is the cash parked by the banks in their specified current account maintained with RBI. Then SLR, statutory liquidity ratio, is in the form of cash bracket book value, gold current market value, and balances in unencumbered approved securities. Thank you. This will be certainly useful for commerce, MBA finance, chartered accountants, and BBA candidates also. Best wishes.